Hello, everyone. Welcome to video 7. In the last video, we were talking about non-arm's length transactions, selling and buying property between family members or very close individuals. In this video, we're going to specifically talk about special treatments when buying and selling between spouse and children. Let's get started. So the subject of this video is called inter vivos transfers. Inter vivos means in life. So these are transfers done while you are alive. The reason we specify inter vivos is because if I should die, many couples will have their will automatically transfer all assets to their spouse. So transfers to a spouse due to a death is treated differently than transfers to a spouse while a person is still alive. So we're considering transfers from living into individuals. So inter vivos transfers. Income Tax Act 73 allows for an inter vivos transfer, a disposition of property while during a lifetime, to a spouse, common law partner, former common law partner. In the Tax Act, any treatment that's allowed for a spouse is also allowed for a common law partner. They are equivalent. So I will move forward just saying spouse, but I mean common law partners as well. Essentially, the transferee assumes tax cost of the transfer. So the rules for general non-arm's length transactions do not apply unless the taxpayer elects out of a rollover. So what does that mean, assumes tax cost? My spouse and I are a team. We live together. We're trying to address life and our economic standpoint of trying to get by. If I have an asset and I transfer the asset to them, it's deemed to be done what's called a rollover. So what a rollover is when an asset gets transferred, but keeps all of its cost-based information. What that means is I can transfer an item with having no consequences to me right now, and all the tax consequences will be in their hands when they eventually sell the asset. Rollover rules exist for spouses. It also exists for if I'm moving assets from a personal business into a corporation business. The business is still the same. This is a matter of paperwork. It didn't actually change ownership, so the cost levels are allowed to stay. We do this because when I move an asset to my spouse, especially the one who still lives with me or still takes care of children, our family unit is in the exact same position as it was before. When I transfer things to a sibling, my brother has his own family, lives in a different house. As family members, we might collude to try and save taxes, but the economic unit does transfer to his house instead of mine. But that doesn't happen when I transfer between my spouse and I. If my spouse and I, especially living in the same house, we are economically in the same position we were before the transfer as we are after. A former spouse also gets these rules because a former spouse might still like we might still share children. We still take care of each other. So even though the relationship might no longer exist because that relationship existed before or pre-existed, they can still follow those same rules. But generally, when I transfer anything to my spouse, we are both combined in the same situation. $20 is the same in my wallet as it is in my spouse's wallet. So we can transfer assets and keep the cost the same so that we don't have to report any income. So change of ownership takes place without any income inclusion or for transfer. Non-depreciable property, the deemed proceeds equals the cost base. So if I bought something for $100,000, their deemed proceeds are considered to be $100,000. My cost base and proceeds are the same. I have no gains, no losses. They get it in at the cost base I had. If it's depreciable property, the deemed proceeds are considered to be the UCC or proportionate of UCC if there's multiple class properties in the class. The reason it's deemed to be the UCC is so if we if we have proceeds above or below UCC, then we might be dealing with recapture, capital gain, and terminal loss, and we don't want that. So it's considered to transfer at the UCC, but the original capital cost of the asset still transfers. So that if my spouse ever sells it for more than its capital cost, they will then recognize all of the recapture and the capital gains that I would have recognized had I sold it. So the UCC and the cost base transfers. Position of transferee, a non-depreciable property, your cost base is the deemed proceeds, and deemed proceeds equal the original cost base, so the cost base stays the same at the old cost base. Depreciable property, my cost is the UCC. Those are the proceeds. I brought it over at UCC, but I still keep the capital cost of the old cost of the transfer because the capital cost denotes when is the income recapture and when does it turn into capital gains, because recapture is 100% included in income, but capital gains is only 50% included in income. So they don't want me transferring an asset to a spouse at UCC and then immediately selling it to turn all of that, what would have been recaptured, to capital gains. So they don't want the capital cost to move over because that would change the income type from me to my spouse. The income's going to be the same if I sold it or if my spouse sells it. So Marge Cardiff gifts land, a cost base of 100,000 and the fair market value of 250,000. And all class 10 depreciable properties, capital cost was 225, fair market value is 310, UCC is 125,000 to her spouse Bernie. So for this depreciable property, it costs 225 and the UCC is 195,000. So at some point, Marge has subtracted $30,000 from her income in CCA. So if Bernie was to sell at the fair market value, Bernie would have to recognize that income of 30,000 of recapture. Since it was deducted 100%, we have to recognize it at 100%. So Marge is deemed to have received proceeds of $100,000 for the land and proceeds of $195,000 for the depreciable property. Bernie will deem to have acquired the land at 100,000. He keeps the same cost base. The class 10 properties acquired for 195,000. The UCC comes in at 195, but the capital cost stays at 225,000. It says the deemed CCA for the asset is $30,000. Because Marge claimed $30,000 of CCA in the past, Bernie is deemed to have already claimed the CCA of $30,000. That just allows it to come over at UCC. So the capital cost is still 225, UCC still 195. So financially, economically, we are in the same position between Marge and Bernie. Only once the assets are sold do we recognize that economic change. We recapture the 30,000 to 225, capital gains above that. You are allowed to elect out of Income Tax Act 73. I'm transferring things over at cost, but you know what? Maybe my spouse and I both have two different businesses, and my spouse is like, hey, that machine you have, I could really use it. Great. I'm going to transfer it to you. We're going to elect out of the rollover so I can recognize that change and recapture and capital gains. And then you are going to bring it in at the new cost base. So if the asset's worth 300,000 and I paid 225, let's have you buy it for that 300,000. I'll recognize the capital gain. Your cost base is now 300,000, and now that could be treated the same. So qualifying transfers result in automatic applications of this rollover. However, you can elect out by filing an election in tax return, no required form. So you elect out. They're going to assume you're rolling over assets between you and your spouse, but you can elect out of it by just putting the sales information on your tax return. Income Tax Act 69 becomes applicable, which results in fair market value disposition. So if we decide to elect out of this rollover rules, we're using the same non-arm's length transaction rules that we would have used for our spouse. The election is considered to have been made if transfer reports transaction at fair market value. So they'd want this to be kind of an all or nothing thing. So when transferring assets to a spouse, we want transfer at cost or transfer at fair market value. I'll recognize all the gain and then they can work it out. So I believe there's an exercise here, and then I think there's another one for so focusing on non-depreciable property. Aaron Schwartz owns land with a cost of 225,000 and a fair market value of 300,000. He gifts his land to his spouse. What are the tax consequences and cost of the property for the spouse after the gift transaction, assuming Mr. Schwartz does not elect to avoid the rollover? How would your answer change if Mr. Schwartz does elect to avoid the rollover? So what this is asking is the cost base is 225, the fair market value is 300. What's the tax consequence to roll it over at cost? What's the tax consequence if we don't roll it over and instead exchange at fair market value? So it goes like this. So we have our cost base and the fair market value, the proceeds are zero. So the proceeds are going to be deemed to be something. If we do not elect out of the Tax Act 73, which means we're going to roll over tax-free, Aaron is deemed to have sold the land at cost. No capital gains to report, and his spouse will now has the land at the cost he paid for it. So the fact the fair market value is 300,000 is meaningless for now until sold because we rolled it over at cost. If we elect out of Income Tax Act 73, then that gift, proceed zero, is deemed to have been sold at fair market value. Aaron will recognize the full capital gain, including the taxable portion in his income, and the spouse's new ACB is the fair market value. The spouse is considered to have bought it at market price. So this rollover rules are kind of an all or nothing. Excuse me. So you have the tax-free or you recognize the full taxable gain. It's slightly different for depreciable properties when we talk about that cost base at fair market value. Depreciable property, part of it is included and subtracted at income at 100%. So CCA deducts from income at 100%, recapture adds to income at 100%. Capital gains above that capital cost are 50% included. So the non-taxable portion of the capital gains on transfer becomes deductible for CCA. So if I have something worth $200,000 and I transfer it to my spouse at fair market value at 300,000, the spouse is going to be pulling it in at 300. I'm only going to recognize half of that amount as income, as taxable capital gains. But they're now allowed to deduct from that new cost their CCA, and CCA is 100% deductible. So by transferring to the spouse, I've recognized half of that difference as income, but they're allowed to deduct the full amount of CCA. So this is an asymmetrical treatment. The Tax Act realizes that this is unfair, then business owners would just transfer all of the assets to the spouse before fully amortizing them so they can get those full deductions. So what do we do? How do we fix that treatment? The solution is the UCC amount, the amount you're actually allowed to deduct for CCA, only increases by the taxable portion of the capital gain. So the UCC will be the transfer's capital cost. My cost was 200,000 plus half of the capital gain. We sold it for 300. So my capital gain was $100,000, which means my taxable capital gain was $50,000. So I added $50,000 to my income. So that UCC that comes over will be 200 plus the taxable portion of my capital gain, 250. So despite that we transferred it at 300,000, that my spouse will only be able to deduct 250,000 through CCA because we're recognizing that part of that cost or part of that change in value was non-taxable. So you don't get the deduction for it. For this example, depreciable property, the cost was 110, UCC is 85, and sold for 150,000 in a non-arm's length transaction. So the seller has a capital gain of $40,000, that 150 minus our cost of 110, and recapture of 25, UCC back up to capital cost. So I'm recognizing the recapture from UCC to capital cost 100%, and then I have a capital gain above that. The non-arm's length buyer has a capital cost for CCA purposes, the UCC, of 130. They bought it for 150, but they have it at 130 because they're bringing it in at that original capital cost plus half of the capital gain. Since the capital gain was 40, 110 plus half that amount, 20,000, is 130,000. The capital cost for capital gains purposes will still be 150. So that non-taxable portion between that 130 and 150 is not going to be taxed again because if we sell it for 170, 150 is our new base cost for capital gains. We're already recognizing that taxes have been covered. So the capital cost will be that fair market value transfer, 150, but the CCA can only deduct the taxable portion, 85,000 plus 25,000 of recapture at 100%, plus half of the capital gain that was included. So that way we can deduct that full amount back from income for CCA. So we're trying to match that tax treatment. If it was included in income, only that amount is what can eventually be subtracted from income again. Fair market value less than transfers capital costs. So now it's, well, I guess we'll just go through the example. A depreciable property with a capital cost of 325, a UCC of 150 is sold for 200,000. So now what we sold it for is a little above our UCC, but below our cost. So there's no gains to worry about, just the recapture. The seller has the recapture of $50,000, 100% included. So the non-arm's length buyer's capital cost is deemed to be 325, that original cost. And that difference between 325 and the purchase price, 200, is deemed CCA. So the capital cost still moves over. So if that is, and if the fair market value were to go up, it will continue to be recognized as recapture up into the original cost. They don't want us transferring an amount that should have been recapture into potential capital gain. It maintains its ability to be recapture. So the capital cost stays the same, but the UCC is the fair market value price. That recapture of 50,000 was added to income, so you can deduct it again from CCA. So the UCC equals fair market value, capital cost stays the same at 325. I think the next question has to do with that depreciable property. So disposition of depreciable property. During the year, Mary Sharp disposed of depreciable property for her house. The property had a fair market value of 225, capital cost of 175, and a UCC of 110. It's the only property in the class. In return for the property, she received fair market value, 225 in cash. Describe the income tax consequences to Mary Sharp and her spouse, assuming she does not elect to avoid the rollover. How does it change if we avoid the rollover? Assume that Mary's spouse will use the depreciable property in his own business. So we have depreciable property we've transferred to a spouse. What is the tax effect if there's a rollover? What is the tax effect if no rollover? So I have another chart here just to help you declare what's going to be included in the seller's income. If the transfer's price equals the capital cost, well, then we have recapture from whatever UCC was up to capital cost. And the buyer we'll bring it in at that same capital cost and their UCC will match it. If we sell it for above capital cost, the seller has recapture and capital gain. The capital cost stays at the new price, but the UCC is the old cost plus half the gain. If it's below capital cost, we have recapture terminal loss. The capital cost stays the same for gain purposes, but the UCC comes through at the transfer price. So that's just a little chart that we've made similar to this one, just to help you try and keep track when you have a series of transactions for depreciable property. Anyway, the original cost was 175, UCC was 110. If it's a rollover, we're not going to have no taxable transaction. So for no transaction to occur, the price must equal UCC. No recapture, no terminal loss, no capital gain. So the spouse, their capital cost will stay the same, their UCC stays the same, and they just continue to amortize it as normal. If we want to elect out of that rollover, Mary Sharp needs to recognize some income. The UCC was 110. The capital cost was 175. So Mary had taken CCA of 65,000. Since the transfer price was 225, we will recognize that recapture of the CCA. And then the taxable capital gain will be $25,000. This difference, the price over capital cost, was 50. So we're going to include a taxable capital gain of 25. The new capital cost stays at the transfer price, so any further gains will be taxed in the spouse's hand, but the UCC equals the old capital cost plus the taxable capital gain that we recognized. So that UCC can continue to be deducted from the spouse's business income. So that is depreciable property. I think there's a couple more slides regarding to children. Inter vivos, so there's no example for this. I'm just going to go through the consideration here. Inter vivos transfers of farm or fishing property to a child is more favorable. When we're talking about to a spouse, you have to either take cost or fair market value. But to a child, that deemed proceeds can be anything in between those two. It has to at least transfer at some cost base or UCC, and at most can transfer at fair market value. So this provides for intergenerational transfers of farm and fishing business to family members. These rules are to help farmers keep their farms within their own family. So the definition of child can be their own child and their spouses. It can go to grandchildren and great-grandchildren. Any other person who prior to being age 19, so 18 or younger, who was dependent on the individual and under custody. So an adopted child, perhaps there's a foster child who's grown up in my house and they are a child to me. The child must be a resident of Canada at time to transfer. So a Canadian family is passing down a family farm to stay in a Canadian family, and the child's going to stay in Canada, then they have this preferred treatment. The proceeds to parents equals, so if we gift it, the proceeds equals the tax cost of properties. The child's tax cost equals proceeds to parents and for depreciable properties. If not gifted, so the tax cost, so if we gift it to our children, it comes through as cost. But we might not want that because there are rules that can protect up to $1 million of gain specifically to farm and fishing property. So I might want to transfer my farm at an amount above my original cost so that I can recognize the capital gain. It will be protected from other rules, and now my child has a higher cost base, so any future gains will be removed by my protected gain amount. So if the farm business has gained $2 million, I will transfer it at $1 million above my cost, protect that gain for me. The child will bring it in at that cost plus the $1 million. So if it was originally $1 million, it's now worth 3. I will transfer it at 2 million. I recognize the gain difference of $1 million. Their cost base is now 2 million. If they eventually sell it, or transfer it to their child at $3 million, they can decide, they can choose that amount and protect the gain in their hands. So conceivably, potentially, farms can continue to be passed down within a family. The family saves taxes on the value of the farm as long as the value change is gradual, $1 million over a lifetime, and it continuously stays within the family unit. So non-depreciable property can be transferred between fair market value, the upper limit, and ACB, your cost basis, the lower limit. So I can choose where in that value change range I want to transfer. And depreciable property must be transferred at least UCC and at most the fair market value. Okay, it's 25 minutes. I just want to get through this last detail in this video. We've been talking about inter vivos transfers while I'm still alive. If I should die and my will leaves items to my spouse or my children, what do we do there? Well, when you die, the moment you die, it is considered all of your assets are deemed to be sold at fair market value, which means the estate of the deceased person will recognize recapture and capital gains for all of their assets. The estate will pay taxes and it will transfer as a cost base to family members at that fair market value. So there's no special rules, there's no special considerations. They have that cost base at fair market value, so only any further changes in their hands. So deemed disposition is fair market value. Beneficiary acquires at fair market value. Deemed disposition is at fair market value. If capital cost exceeds fair market value, the beneficiary retains old capital cost. So if the fair market value was less than I paid for it for depreciable property, they do maintain that old capital cost so that they can continue potentially recognize recapture. But generally, they will bring it over at fair market value. So the deemed fair market value disposition rules apply to all capital property. We have depreciable property at a cost of 100,000. Fair market value is 60,000, UCC of 50. The property is left to son. The deceased person is deemed to have sold it at that fair market value, 60,000. So there will be a $10,000 recapture, but the son will bring it in as their UCC balance of 60, and they will maintain the original capital cost of 100,000. So that $40,000 between the original capital cost and fair market value is deemed to be previously claimed CCA, so that if the son ever does recognize that difference, it would come in as a recapture up to the $100,000. If I leave everything to my spouse in my will, then it transfers at cost. Everything's not deemed to be sold, it's just deemed to be put in the spouse's name, so there's no tax effect now. So it allows a couple to save taxes on someone's death until both individuals pass away. If I leave, and I can elect out of this, but maybe we would, maybe we wouldn't, but it's the same thing. So I've died. There's no tax consequences when I die because everything's transferred at cost. We will recognize all that income when my widowed spouse now passes away. Farm and fishing property to a child, a rollover for Tax Act 70, can elect value between ACB and fair market value. So if I die, everything's deemed to be sold at fair market value. So though we don't need to worry about those not regular non-arm's length transactions, non-arm's length transaction rules are trying to be, hey, are you trying to manipulate the price to get a good system? But no, they're getting my assets because I died. So we don't really consider non-arm's length transaction. But those beneficial treatments for spouses and farming and fishing property to a child still can be treated the same way. Roll over at cost or choose or choose proceeds between ACB and fair market value. So those rules still come into play for someone who's passed away. Okay, so we had a couple long videos regarding non-arm's length transaction and special rules for inter vivos transfers. When we come back, we will talk about income attribution rules. When trying to transfer assets to save taxes on income by Splitting the income with family members, sometimes that income still has to be recognized in my tax return, even though someone else is now receiving it. And we'll go into those details later. Thank you for your time. I'll see you in the next video.